What's driving markets? Welcome to Market Take. Each week we'll bring you our insights on the latest market and economic trends that are impacting investments. I'm your host, Vivek Paul, Global Head of Portfolio Research at the BlackRock Investment Institute. This week, we discuss why we're rethinking how to diversify portfolios given the economic transformation we see happening now. With a wide range of market and economic outcomes now possible, bonds less reliably shield portfolios against equity sell-offs. We look to expand our diversification toolkit. It's not about replacing bonds, but introducing unique drivers of risk and return. To help track the wide range of possible outcomes, we and BlackRock portfolio managers created 5 scenarios to map different market and economic outlooks over the next 6 to 12 months. The ability of government bonds to shield portfolios from risk asset sell-offs has been unreliable in this new regime. Sticky inflation has upended the historical negative correlation between stock and bond returns. And that's why we think investors should consider adding new diversifiers alongside bonds, like gold and Bitcoin. We think gold has diversification properties because its value drivers are different than for those equity and bond returns. Gold prices have surged this year as investors seek to bolster portfolios against high inflation, and some central banks seek alternatives to major reserve currencies. Bitcoin is highly volatile and vulnerable to sell-offs, but we think it could appreciate over time when its predetermined supply is met with growing demand. We think Bitcoin should be less correlated with major risk assets over the long term because its drivers of value are different from those for traditional assets. Demand for Bitcoin is based on the potential to become more widely adopted. We see several factors that could spur wider adoption of Bitcoin. Bitcoin allows for seamless transactions across borders. Anyone can participate in it, and it's decentralized, with no direct government ability to increase or decrease supply. Here's our market take. We stay pro-risk headed into 2025 and see US corporate profits staying strong even as US growth moderates. Yet if markets were to flip-flop in their pricing of interest rates, bonds may not effectively hedge against any pullback in risk assets. And that calls for rethinking portfolio diversification. For details, read our weekly market commentary. Go to www.blackrock.com/weekly-commentary. Thank you for tuning in. If you've enjoyed this episode, subscribe to Market Take wherever you get your podcasts.
This material is intended for informational purposes only and does not constitute investment advice, a recommendation, or an offer or solicitation to purchase or sell any securities, funds, or strategies to any person in any jurisdiction in which an offer, solicitation, purchase, or sale would be unlawful under the securities laws of such jurisdiction. The opinions expressed are as of the date of publication and are subject to change without notice. Reliance upon information in this material is at the sole discretion of the listener. Investing involves risks. BlackRock does and may seek to do business with companies covered in this podcast. As a result, listeners should be aware that the firm may have a conflict of interest that could affect the objectivity of this podcast. For more information, visit blackrock.com